The asset is a financial asset, fair value through P&L, so must be revalued to its fair value of 150. Fact, simple. There is a gain of 50 recognized in P&L. There is a gain of 50 recognized in P&L. The first thing you sort out is the carrying value. For me, the carrying value is home. For me, the carrying value is about accounting standards. And it's possible that in questions that could be expanded to be worth 2 marks. Because if the question wants you to, or you think judge it appropriate, you could start explaining what is meant by fair value. You could justify why it's fair value through P&L, for example. Number 2, I'm now thinking tax base. Yeah? I am now thinking tax base. Now when I'm thinking tax base, I'm thinking, yeah, for taxation purposes, what is going on? I feel I'm playing away. I feel I'm vulnerable. I feel I'm having to make a little stab, a little guess. But the non-cash gain is not subject to current tax. For tax purposes, the revaluation gain is ignored. It is a non-cash paper. It is a non-cash paper. Unrealized gain. No current tax is assessed. For tax purposes, the revaluation gain is ignored. It's non-cash, it's paper, it's unrealized. No current tax is assessed. The tax base remains 100. The tax base remains 100. I am a passionate believer in referencing your workings when you're doing numbers, and I'm a passionate believer in leaving space when you are writing. Full stop, leave a space, new paragraph. So you're giving the marker the opportunity of giving you 1 mark at a time. Step 3, we're going to deal with the temporary difference. Yeah? Step 3, we're going to deal with the temporary difference. So you've sorted out your carrying value, now we've sorted out the tax base, and now we know the temporary difference is 50. The revaluation gain has created a taxable temporary difference. The revaluation gain has created a taxable temporary difference which gives rise to a deferred tax liability, which gives rise to a deferred tax liability. So the revaluation gain has given rise to a taxable temporary difference, which creates a deferred tax liability. Yeah? Because if we're dealing with a gain, gains are ultimately taxable, and if a gain is ultimately taxable, you are going to pay tax, so it's a deferred tax liability. Now, mathematically, that gain is simply that deferred tax, 25% of 50, and therefore is 12.5. So I can easily see how a deferred tax question gets examined, scenario gets examined for 3 or 4 marks. Yeah, where you are writing and there is 1 number, but you will only ever get 1 mark max for the number. Now, everything that I'm now about to say is a repetition, effectively, of what we have just done. If this number base is a bit quick or you're not quite sure what's going on with the numbers, set out a little process that you have your carrying value and the opening balance was 100. We've recorded a gain and the gain is 50 and therefore our year-end carrying value is 150. When we think about the tax base, the gain is ignored. So when we think about our temporary difference, when we think about our temporary difference that we're looking at is 50. This temporary difference is a taxable temporary difference. It's a taxable temporary difference because you're dealing with a revaluation gain. We're dealing with a tax rate of 25%, and therefore we've got there 12.5, which is your deferred tax liability. So your carrying value minus your tax base gives you your temporary difference. Year end, anyway, that's another way of recapping it. And this gives me a brilliant shorthand for talking you through the process, because effectively this is step 1, effectively this is step 2, and then effectively this is step 3, and it shows you the answer. I'm happy with this recap, but I'm still going to recap it again, because I'm going to look at this backwards and forwards and upside down to make sure that you are genuinely happy with everything that is going on. So let me recap in terms of double entry. So when we are recording the gain, we debited the asset by 50 and we credited our profit and loss account by 50. Now there was no current tax on the gain, so we came up with a deferred tax, and we said that there's a provision for deferred tax as a liability, and this would be a non-current liability, and this would be 12.5. So when I think about the double entry, I know that the asset goes up, and I put a gain in the P&L, and I know that this creates no current tax, but it creates a deferred tax. By definition, deferred tax is a non-current liability, by definition. Where do I debit?
P&L.
Thank you. Yeah, debit my P&L, I debit my taxation charge. I have an expense. Ladies and gentlemen, I'm excited. Why do we account for deferred tax? The reason we account for deferred tax is matching. I have reported a profit this year in the P&L of 50. No current tax was assessed, so I have matched the tax effects of that evented transaction. Because the profit was 50, I have made sure there is a taxation charge of 12.5. Now my method of arriving at the numbers is always through temporary differences and the balance sheet. But the big picture is that you are matching. Yeah? So, yeah, this is why we do deferred tax. There is a matching. There is a matching process going on. This is my profit, this is the tax on my profit, and I've paired the two together. I'm still dwelling on this small example. In this example, I chose that our asset was called fair value through P&L. And therefore, because the asset was called fair value through P&L, the gain went to P&L, and the tax on the gain also went to P&L. If this was an equity investment, I could have chosen to have it at fair value through OCI. I could have made an election at the beginning to have it as fair value through OCI, because that way you would avoid fluctuations in P&L. If you're going to own an investment for a long period of time, you might want to avoid the fluctuations going through P&L, so you might choose at the beginning to have it fair value through OCI. If the investment was called fair value through OCI, you would still increase the asset by 50. The gain of 50, however, would go to OCI. There would still be a deferred tax of 12.5. But where would you charge the tax? I don't even have to think about it. Tax goes in P&L, tax goes in P&L, tax goes in P&L, because that's where your profits are. Because your profits are in the P&L, you put the tax in the P&L to match it with. But hang on a minute, if the gain is in OCI, where would you take the tax? OCI, yeah. I mean, it's not an enormous step, but it's an absolutely logical step. You normally have a taxation charge, you always have a taxation charge in the P&L, and that tax relates to the profits in the P&L. If you've got gains in OCI, and there are tax consequences on those gains, then you report that in your OCI.